The governments have a trap for your money. And there's a battle for your money, whether you realize it or not. The governments and the central bank policies have created a trap for your money, which of course gives the banks more power, more control for themselves, the central banks and of course Wall Street, because they don't want to lose their grip, but it is slipping fast. In this video, I'm going to break down how this is predictable, how all nations do this towards the eventual end. I'm going to break down the actual trap, the hidden control measures they are using to trap and to steal your wealth, and what many people are doing today to break their grip and gain financial sovereignty back fast. So let's go. All right, welcome back to the channel. If you are new, my name is Mark Moss and I make these videos to change the way you think about money because almost everything you have learned as wrong, the system is changing super fast. There are plans that the government has to trap your wealth, and if you can learn to see these clearly, you can have more freedom and success in your life. All right, so real quickly, I want to talk about something called capital controls. Now, capital controls are nothing new. As a matter of fact, every government goes through capital controls at the late stages when their currency is losing value so fast they can't get away from it. Now, I want to talk about something called the Mundell-Fleming trilemma. I'm not going to go deep into this because I've covered it in a previous video, but basically you have a trilemma. A trilemma is sort of like a dilemma. A dilemma is 2, trilemma is 3. And so every country with their own currency, they have these 3 things that they can manage. One is the exchange rate management, allowing money to be changed in and out. They have the monetary autonomy. Do we control our monetary system? And then we have the free capital mobility. So that's basically, can they control the interest rates? Can they control the monetary supply? And the free flow of capital going in and out. The problem is that they can't manage all 3 of those. If they bring the interest rates down and print a lot of money, the money loses value, and then people will want to trade that money that's losing value, becoming worth less or worthless, for other currencies or other assets that are going up in value, which is this part. Now, governments do things to protect this, and so China did this when they banned all cryptocurrency. So they don't want people to have this escape route. They don't want to allow that capital to exit. Now we can see that if we look at like the official definition of capital controls, we can see that they are any measure taken by a government, of course, to limit the flow of foreign capital in or out of the economy. So sometimes they don't want capital to come into the country to buy up all their assets because they're too cheap, or they want to prohibit capital getting out of the country because as capital leaves the country, their currency goes into a tailspin, dropping down. They also, policies may restrict the ability of citizens to acquire foreign assets. Again, they don't want you to take your failing currency, the US dollar, and go buy assets in another country, so they prohibit that. So you can see how that's done. Now, we can see if we go back in time, which a little bit, you know, I love to talk about history. Really, we can see the United States really started doing this back in 1933 when the banks took a national holiday. They took a brief holiday, and what happened is the banks shut down. And then they didn't allow you to pull your gold out anymore. They made owning gold illegal, and that was capital controls. The reason why they shut the banks down is because if they would have stayed open, everybody would have gone and pulled their gold out of the banks. And so to control the capital, they shut them down, they made it illegal, and when they opened them back up, you weren't allowed to get your gold. And so they've been doing this for some time. Of course, that was in 1933. We have way more recent examples. So we can see here more recent examples. June 29th, 2015, the European Central Bank froze support to Greece. So European sovereign debt crisis, so they had the problem in Greece. And basically Greece responded by closing its banks. The same thing, closing the banks, implementing capital controls from June 29th through July 2015. And why? Out of fear, the Greek citizens would initiate a run on domestic banks. They were afraid everyone was going to go to the bank and pull their money out, which of course they would have. So they did capital controls and they banned that. They put limits on the allowable cash withdrawal limits and so restrictions on money transfers. We can see this has been done many times in recent history. We can go back way back in history, but here Russia, it happened. Iceland, it happened. We can see that happening. We can also see it happening here in India as well, back in 2013. So this is what governments do when they know their currency is failing and they want to prohibit you from getting out of it. To get on, they want to take away the lifeboats so you have nowhere to go. Now, I hate to tell you this, maybe this is red pill for you, the governments have a history of stealing your money. As a matter of fact, the governments and the central banks are set up in a way to actually steal your money. That's actually the point. Of course, we had the creation of the Federal Reserve. The Federal Reserve was created back in 1913 at the same time as the IRS. So the Federal Reserve can create as much money as they want, and then the IRS comes to take it away from you. They put those two into place. Now, the reason why they did that is because they put the central bank in place, the Federal Reserve, to create a bunch of fake counterfeit money. Remember, gold was money up until that time frame. So now they can create unlimited fake counterfeit money, and why would anybody use that? Gold's money. Why would I use this fake paper? Well, let's create the IRS at the same time. So here's what we'll do. We'll create a policy where people have to spend all year going and collecting this fake paper just so they send it back to us at the end of the year. So both those agencies were done at the same time. Now, the Federal Reserve creates money. As they create more money, it inflates the money supply, which then makes all the existing currency worth less and less and less. We can see this as the definition here. We can see inflation is specifically the arbitrary increase in the supply of fiat currency. So a lot of times people want to get into this very nuanced inflation debate. I believe, per Milton Friedman, that inflation is always and everywhere a monetary phenomenon, as they said here, increasing the supply of fiat currency. They increase the supply of fiat currency and it gets into the system in different places. So lumber's up 300%, homes are up 30%, things are up different amounts, but it's the monetary supply. And it says the actual unit of perception that we are using to value assets, so that's dollars, right? Everything's priced in dollars. US home prices in dollars, Bitcoin in dollars, gold in dollars, i.e. the dollar is being diminished. So the unit of account is being diminished by them creating more. But here's where the trap really comes into place. We can see here, this is from the IMF, the International Monetary Fund. They're kind of like the central bank above all the central banks. And they created this working paper, IMF, the liquidation of government debt, written in 2015, if you can see that. And this is where they basically spell out the plan of how the governments can get rid of debt. And you're not gonna like it. High public debt often produces the drama of default. Because, of course, when you can't pay your debt, you default, right? But there's a drama of default and restructuring. But debt is also reduced through financial repression. The debt is also reduced through financial repression. What does that mean? A tax on bondholders and savers. Bondholders and savers. So when I save money, they tax that savings by creating more money because they're making my savings worth less and less and less. It's also a tax on bondholders, people that buy the government debt. So whether you're buying bonds or you're saving cash, they're stealing your money per this paper. By having negative or below market real interest rates. So they pay you 1% on your bond, but the problem is that inflation is 5% or 10% or 15%. So the 1% is not offsetting the 15% you're losing. Does that make sense? And it says, after World War II, capital controls and regulatory restrictions created a captive audience. Capital controls and regulatory restrictions created a captive audience. You getting that? For government debt, limiting tax base erosion, and financial repression is most successful in liquidating debt when accompanied by inflation. So financial repression, stealing your money, is the most successful in liquidating debt and getting rid of their debt when they use that accompanied with inflation, which of course we are seeing in droves. I have a couple more pieces. I'm not going to pull those up, but just to give you a visual representation, this is what I'm talking about. In 1988, $20 would have bought you this basket of goods. In 2005, $20 would have bought you this basket of goods. In 2013, $20 would have bought you that basket of goods. And today in 2021, you might just get this one bottle for $20. And that's exactly what's happening. So you still have the same amount of money in your bank account, but it buys you less goods and services, which of course are wealth. Now, this is part of this financial repression, is this trap. They're trapping you in the system. They've created this system to keep your money so they can steal it from you through financial repression, through negative interest rates. So this really starts with the rise of Wall Street. So retail stayed out of Wall Street for most of America's history. Wall Street and investing was done for very sophisticated business professionals who knew what they were getting into and wanted to invest into these businesses. It was not done by normal people like me and you and people watching this YouTube video. It wasn't done like that. Retail stayed out of Wall Street. They weren't involved, but a little government plan to get everybody involved happened. And so this was formed, ERISA. This was back in 1974. We can see if we go over to Wikipedia, it's the Employee Retirement Income Security Act of 1974, or ERISA. And basically it establishes a minimum standards for pension plans in private industry. So I have a plan. We need to get more people's money. So what we'll do is we'll create this plan to force them to invest all their money in the stock market and the bond market so that we can use financial repression to steal their wealth. Save it and invest it, and we're going to steal it through inflation, and that happened in 1974. Then in 1976, Vanguard funds opened up, and they created another method, and it was known as like these index funds, and they created something known as a 60-40 portfolio. And that means that people in your 401k or your fund through Vanguard, which is the largest funds available today, they pretty much own everything, majority interest in everything, and they have a 60-40. Hey, put 60% in stocks, put 40% in bonds, just hold it forever. Don't try to time the market. It's time in the market, right? Hold through the dips, etc. Basically, keep your money in so we can keep stealing it from you. Then we saw ETFs launched in 1990s. And it was all this plan to force people into the stock market so they can use this financial repression against them. And then one thing you have to understand is that most financial advisors today are just sales reps. They work for a company like Charles Schwab and they sell you the products that Charles Schwab sells. They're not looking at individual plans customized for you. They got their products and they want to match you with their products. And so that has become a big problem. They need to keep you trapped in the system. But the thing is that investing's changed. The world's changed and investing has changed. All right. Today, stocks are at all-time highs with crazy PE ratios, price to earning ratios. When our parents were investing, they could get 6-7 times PE ratios. Today, you're going to pay 20 or 30 times, way overpriced. There's no earnings that could ever pay that back. And at the same time, bonds have negative yields. So when I was even a kid, a bond could pay you 15%. You could put, $1 million in the bank and you could live for the rest of your life on that bond. Today, bonds pay 1%, but again, the rate of inflation is 15%. I mean, homes are up 30%. The CPI tells us up 4.5%, 5%. Whatever number you want to measure, even at the CPI rate of 5%, if the bond's paying 1%, I'm still losing 4% per month. So this 60-40 split isn't working so well. And that means that traditional investing is dead. That's why I'm trying to change the way that you think about money. Like I said, and these financial advisors are sales reps trying to push you into these funds, these Vanguard funds, to just go into stocks and just go into bonds and everything's going to be okay. But the problem is that it's changed. We can see here over and over and over. This is for a couple months ago. 60-40 investing is now actually working against you. That's from Money Magazine. This is Yahoo Finance. The 60-40 rule of investing is dead. It's time to get more creative. This was from a few months ago. We can see in Kiplinger's, I just pulled a couple mainstream news sources, RIP 60-40 portfolio, it's dead. This is just from that's from a year ago. It's dead. Investing has changed and you need to get with the times. So what is that? Well, remember, it's a trap. The International Monetary Fund, the IMF, outlined this in 2015 that they want to trap your money in the system so they can steal it from you through inflation and through negative yielding debt. So in the bond market and in the stock market. Now, the millennials have completely changed the game, and you either join them or you become victim to what they're doing. The millennials have changed the game. They're getting their education, instead of going to university, they're getting their education on YouTube, like you are watching this video, changing the way you think about money. They're getting their information from the internet, not books. Books are outdated. They can't print them fast enough. The world is changing too rapidly. They're using technology. They're using things like Robinhood to just execute buy and sell orders right now. They can manage their whole portfolio. When I started investing, I'll tell you how old I am. During the dot-com boom, I was just kind of starting out my career during the dot-com boom in the late 90s. Well, that was for the internet. So that means there was no internet, which means we had no apps, we had no internet to even buy and sell stocks. We had to call a broker on the phone to execute a trade. Today, kids just have Robinhood, they can see their whole portfolio, so they don't need these financial advisors to do that for them. They can do it. The information is at our fingertips. Again, how old I am, I remember when you used to have to call a travel agent because you had no way to know what the flights were, what times, what the prices, and so you'd call a travel agent who had visibility to that. But today, I don't need to do that. I'll just go on Expedia. Right? The real estate industry is, I believe, dead as well because I just want to look at the houses myself. I can go on Zillow or Realtor.com. I don't need an agent to be in my way. And also, we don't need a financial advisor to be in our way either because we can get our own education, we can get our information, and we have the technology to manage that on our own. That's how fast things are changing. There was this article that came out in the Wall Street Journal. Rich Millennials to financial advisors. Thanks for the golf invite, but you can't invest my money. You don't know what I want. You don't have a vested interest in my money, and you don't know what I know, and even if you did, you're not allowed to tell me. So for example, you work for Charles Schwab, or if you're working with a financial advisor for Charles Schwab, go to them, sit down and ask them what they think about Bitcoin. They're not even allowed to talk to you about it, even if you ask them. So they don't know the information, and even if they did, they're not allowed to tell you. They're not working for your best interest, and that is kind of the way that the world is today. We can see that it's changing very rapidly. As a matter of fact, 70%, we've gone in the last 9 years, 70% of people are choosing to invest their own portfolios, do it yourself, kind of like what you're watching this video for right here. All right, now, the thing is, though, I do want to say is that professionals have changed across all areas, all right? So I want to tie this together for you here real quick, all right? So professionals have changed. So for health information, for example, you used to have to go to a doctor. Now, of course, I still recommend going to doctors, but the thing is that a doctor kind of knows their limited area of what they know about. But today we have all the information at our fingertips, and because it's my body, I have a vested interest in my body, I can do all the research as well, all right? Same with asset protection. So you might, well, back to the health thing, for example, doctors that come up in the system, all they're taught is this, and they're taught to prescribe you a pharmaceutical for everything. You have heartburn? Let me write you a prescription for your heartburn. Rather than, let's take a look at your diet. What's in your diet? Why don't we add more vegetables, more minerals to your diet, which will then neutralize the alkaline in your body, which will then take away your heartburn. Naturally, I don't need to write a prescription for that. Now, if you asked your normal doctor if that is a thing, they think that's quackery. And so doctors have to unlearn everything they've learned and then have to go learn about natural medicine. The same is true with asset protection. So you go to your typical attorney and say, hey, I need to protect my assets. They said by 2030, I'll own nothing and be happy. How can I protect my assets? And they're gonna say, well, I'm an attorney, I've learned this legal system, and this is the only way to do it. But that's not true. There's a lot of other ways that you can do this that I'm using to protect my assets, that keep them private and protected from anybody, including the government. Also, tax minimization. So your CPA and your tax attorney learned one set of rules, but there is a whole another set of rules that are available to you if you spend the time to find the right advisors. All right, now, I'm not saying that you don't need professionals. You do. You still need professionals, but it's more about you directing them yourself. You're doing some of the research, you're getting your information, you're getting your education, and then you're using some of these professionals as opposed to just outsourcing everything to them and relying on them. And that's why I said you should direct them yourself. So use the professionals, but in conjunction with your own education, your own information, and work with them. That's what I'm doing. That's how we're having success in today's day and age. We're not traditionally thinking about the 60-40 split anymore. Most millennials today want real estate, something tangible, something that produces cash flow. I want Bitcoin. I want cryptocurrencies that are outpacing games. I want to think about ways I can protect my assets out of the box. Are you thinking about that? Give me some of your top ways to invest today that are not going through a financial advisor, that are 60-40 splits. Leave me a comment and let me know what you think. Of course, give me thumbs up on this video if you like it. If you don't like the video, give me a thumbs down, but at least tell me why in the comments down below. And that's what I got for you today. All right, to your success. I'm out.